You've probably heard that magical Forex indicators are the secret to getting rich quick. You see all these gurus with charts covered in dozens of squiggly lines, promising you a can't-lose system. Well, I'm here to tell you the truth. Most traders think indicators are what will finally make them profitable. But the reality is, they are just tools, not a crystal ball. And if you're using them wrong, they're probably costing you money. Today, I'm going to reveal what actually works when it comes to Forex indicators, and it's a lot simpler than you think. Let's get one thing straight right from the start. The real purpose of an indicator is not to predict the future price of a currency pair. Anyone who tells you that is selling you a fantasy. Indicators are designed to help you understand what the price is doing right now. Think of them as the dashboard of your car. The speedometer doesn't predict you'll crash, it just tells you how fast you're going. Similarly, indicators help you interpret price action. They can show you the momentum of a move, the strength of a trend, or even hint at potential reversal points where the market might turn around. They are there to add context and confirmation to what you're already seeing on the chart, not to make decisions for you. So, stop looking for an indicator that tells you where the price will be in an hour. Instead, start using them to better understand what's happening in the present moment. So, if indicators are just tools, which ones should you actually have in your toolbox? You see traders with charts that look like a modern art painting, just a mess of colors and lines. That's a classic beginner mistake. More indicators don't equal more profits. They just equal more confusion and analysis paralysis. In reality, you only need a handful of the right ones to be effective. I'm going to give you the only 3 you really need. First, moving averages. These are fantastic for quickly identifying the overall trend direction. Is the market going up, down, or sideways? A simple moving average can tell you that at a glance. Next, the Relative Strength Index, or RSI. This is your momentum gauge. It helps you spot potentially overbought or oversold conditions, where a price move might be running out of steam and is due for a pullback or reversal. And third, the Average True Range, or ATR. This one is all about risk management. It measures market volatility. By knowing how much a currency pair typically moves, you can set smarter, safer stop losses that don't get taken out by random market noise. That's it. Moving averages for trend, RSI for momentum, and ATR for volatility. Smart, profitable traders keep their charts clean and their analysis simple. They focus on what matters, not on clutter. Now, here's the most important rule of all, the one that ties everything together. Price action always comes first. You must burn this into your brain. Indicators follow price. Price does not follow indicators. They are what we call lagging because they are calculated based on past price data. The price has to move first before the indicator can react. This means that if you rely solely on an indicator crossover or signal, you are always going to be late to the party. The real skill is learning to read the price chart itself, understanding candlesticks, support and resistance levels, and chart patterns. Your indicators should only be used to confirm what the price action is already telling you. For example, if you see a bearish reversal pattern forming at a key resistance level, and at the same time, the RSI is showing an overbought reading, that's a powerful combination. The price action gave you the initial clue, and the indicator provided the confirmation. Never take a trade just because an indicator told you to. Always, always, always start with price. So, let's recap. Indicators are tools to help you understand price, not magic wands to predict it. You don't need a cluttered chart. A few simple tools like moving averages, RSI, and ATR are more than enough for a solid analysis. And most importantly, price action is king. Your analysis must always start with what the price itself is doing, using indicators only as a secondary confirmation. Use these tools wisely and logically, not emotionally. Master these concepts, and your lines be miles ahead of the 90% of traders who are just chasing flashing signals on their screen. If you want more clear, simple, no-nonsense Forex lessons that actually work, make sure you subscribe to Wealth Flow Trading. We're dedicated to cutting through the noise and giving you the skills you really need. Thanks for watching, and I'll see you in the next video.